Financial Modeling Overview. In this section, we'll dive deeper into the actual financial models that underlie these project financing transactions. So, what are the basics if you're making a financial model here? Well, first of all these financial models are built in Microsoft Excel or Google Sheets. They're all cash flow, discounted cash flow models that take into account upfront costs, such as equipment, permitting, or construction, and ongoing costs like maintenance and operations and insurance costs. They all include revenue projections. That would primarily be the cash flow from the contracts, but also from other incentives that may be ongoing, just like upfront costs may be offset with incentives. All of these need to be included. If you're looking at a solar model, it should be post-tax. If you're looking at any model that does not include tax credits, pre-tax is generally fine. Now, to look at a solar project example, a different project, a bit smaller, this one has capital expenditures of $3.4 million, $4.90 a watt. Quite expensive for a solar project, but not out of the ordinary if you're talking about a rooftop and canopy project in an urban area. Contracted rate in this case, however, is also commensurate with that, 28 cents per kilowatt hour with a 2.5% annual escalator. Into this would come tax equity investment of $1.49 million. Tax equity investment generally becomes a partner in the special purpose entity based on this 30% investment tax credit. The EBITDA margin on the project, however, is 93 to 94%, indicating strong profitability, and a net developer profit of nearly $650,000. So what does that mean, though? We really want to think about profitability and returns in the model. That's a lot of what this is for, to understand the costs that go in and the revenue that comes out, and how much money each party gets to take home based on how much they contributed in the beginning. So, as I mentioned, these are all discounted cash flow models, and as such are evaluated primarily on discounted cash flow metrics such as net present value and internal rate of return. Net present value compares the present value of all the cash flows across the project's life against the actual cost to implement that project today. Positive net present value indicates that the project is expected to generate more money than is put into it, including all things, including construction cost, operation cost, and the cost of financing. One way to think about net present value is, if I were to use capital at a certain rate and spend everything that I can consider, including my time, how much money would I have left over? How valuable would this project be? A net present value above zero is a project that's worth something. If it's worth $1, that means you covered all of the costs in the model. If your costs were already included in the model, an NPV of 0 is acceptable. If your costs were not included and you are looking at this as a developer profit, then you can think of your NPV as the profit that you would take developing this project. IRR is quite similar to NPV. It is, in fact, the discount rate at which the NPV of a project equals 0. It's really just another way of comparing the returns. Sometimes you want to see the return in terms of the dollar value it's worth. Other times you want to compare it to other investments that you may have with differing rates of returns. Now, here's a snapshot of the input section of a solar model. You can see there's a lot going on, but what are we doing? We're capturing the production of the system under the production assumptions. In this case, we look at the number of kilowatts the system is and the capacity factor, which is a measure of how much of that system can be utilized throughout the course of a year. That yields a production value in kilowatt hours, which is the unit of sale, and an asset life of 25 years, which determines how long we model out. We have other revenue assumptions looking at price, escalation in price, renewals. We have capital expenditures, expense assumptions here, really looking at operations maintenance, insurance, general overhead, and major maintenance items. In fact, in this model are stated in dollars per kilowatt. Then we have a whole section for the tax credit and tax equity. The amount that is eligible for use in the tax credit, percentages of tax credits, and different ways to calculate how much you get from the tax equity investor and how they need to get repaid. Down here, we have some calculation of the returns that are associated both with and without leverage, and a profitability analysis for the developer. You can see here some of the actual cash flows themselves. This is a quarterly model set up this way, largely so that I can demonstrate it on the screen. These models are typically annual for a summary model or monthly for a detailed model. Rarely or never will you see a model go in higher granularity than a month. It is possible, but a monthly model is in a way the gold standard, and an annual model is great for a summary model, particularly when you are in the negotiation and discussion phase and you want to show what your project finance product would look like in simple terms. Here you can see those items in the input section broken down and spread over time: production, revenues, expenses, and EBITDA.